The three types of savings accounts we discussed earlier all have a common feature. They're all going to pay you some interest on your funds. There are a couple factors that'll determine the interest rate you receive. The first is the relative supply and demand of the funds, and the second is the relative frequency with which you'll be accessing your account.
We've seen how supply and demand work in the goods and services markets and in the labor market. This applies to the supply and demand for funds, too. As Amanda discovered, the money that you put into your savings account isn't really there all the time. The bank takes your money and lends it out to other people for car loans, mortgages, and personal loans. The supply of funds, therefore, is determined by how much people save. The demand for funds is determined by the people and firms that are looking to borrow money.
The price in this market is the interest rate. When the amount of money in savings accounts is relatively high, the interest rate will be lower. And when the number of people looking to borrow funds exceeds the funds available, then the price of borrowing, the interest rate, is going to be higher.
The supply and demand for funds applies to the economy as a whole. The other factor determining what interest rate you'll get on your own savings account is how frequently you'll be accessing your money and what kind of balance you have. If you only keep a few $100s in your savings account and frequently transfer it to checking to use, the bank knows it can't reliably use that money to make a loan to someone else. You'll want your money at very uncertain times, which is your prerogative, but it is then the bank's prerogative to pay you a low interest rate. A CD, which has a specified balance and length of time, will pay a higher interest rate for those reasons. The bank can lend out your money with more certainty.
Now, don't worry that your bank lends out your money. Most banking institutions are insured by the FDIC for up to $250,000, so you're guaranteed to get your money back. Also, if you've ever had a loan, you've benefited from your bank's ability to lend out its deposits.
You've probably heard of the term compounding. When you earn interest on your account balance, the interest is added to your balance, and your balance is then larger. Over time, you'll notice a snowball effect. The larger your balance, the more interest you earn, and the larger your balance gets. The time value of money is a concept that lets us calculate how much money we need to save now in order to reach a target sum of money in the future. The interest you earn on the various types of savings instruments is considered taxable income. When you do your taxes in April, you'll add the earned interest to your salary or wage earnings. That is, interest income is included in your gross income. You pay taxes on interest income in the same way you pay taxes on income from wages or your salary.